Hi again, I'm Brian Becker with my colleague Dan Brown from Richardson Financial. We're here to give you the April investment and economic update. Well, Dan, there's only one word I can think of to describe April. It's ugly. Okay, it doesn't matter if you're talking about stocks, bonds, US, international, big cap, small cap, short duration, long duration, everything's in the red, just different shades. So why don't you tell us a little bit more about what's causing the volatility that all the markets have experienced this month?
Sure, Brian. So the sources of volatility in April are the same sources of volatility that we saw the first quarter of the year. So inflation remains high. The Federal Reserve is talking tough about raising interest rates to fight inflation. And then unfortunately, the Russia-Ukraine conflict continues to drag on, now going into its third month. So let's go back to inflation for a second. So we saw inflation for the latest print surged to about a 40-year high, and we see that at about an 8.5% year-over-year rate. And that translates into the Fed and what they've talked about and what they intend to do. And the Fed, the last 2 months or so, has come out pretty forcefully talking about the fact that they intend to get inflation under control. And the way that they're going to do that is by raising interest rates. So we saw the first rate hike in March, and they're talking about raising interest rates pretty aggressively here the next couple of months in half-point increments, so 0.5%. So that caused a little bit of volatility in the markets, including the fixed income market. And then lastly, again, the Russia-Ukraine conflict continues to drag on going into its third month. And that also is feeding back into inflation with the higher energy costs because energy just isn't getting out of Russia into Europe and other Western hands.
Thanks for that summary, Dan. If we can, let's take another minute and dive into the fixed income and interest rate kind of component of what's going on right now. Because as most of our clients know, we put fixed income into portfolios for stability, right? It's less volatile, lower returns, but lower volatility. So kind of walk us through what's happening again and why within that interest rate fixed income component of the portfolios.
Sure. So as you mentioned in the intro, Brian, fixed income hasn't been immune to losses year to date and even over the last year. And again, much of that is attributed to the rising interest rate environment that we've had in the last year or so. And we expect more to come because the Fed has told us they intend to raise interest rates fairly aggressively over the next maybe 9 to 12 months here. And the bond market has took that message to heart and pushed interest rates up. And just to recap where we've been with interest rates historically, fixed income investors have really benefited for the last 40 years since the early 80s up until recently because we've been in a slowly declining interest rate environment, which has pushed prices up. So it's been a favorable tailwind, and that could be coming to an end. Not to say that interest rates are going to go up dramatically, but again, they've gone up a little bit here the last year or two off the COVID bottom, and we expect them to go up a little bit further as the Fed raises interest rates. And what that's meant to traditional fixed income investors is negative returns. And I think, you've got some observations on, how we've positioned the portfolios and the types of exposure that we have to traditional fixed income.
Right. And what we've done in the portfolios is for whatever your normal stock bond balance would be, we've held fewer bonds than normal in anticipation of these interest rates going up. And something that I think a lot of investors remember, and people at home say it with me, when prices go up, yields go down. There's an inverse relationship there, but the opposite is also true. As yields go up, prices go down. And that's what we've seen lately. Yields have gone up, prices have gone down. This year so far, the speed at which both of those pieces are moving is what set bonds backwards. It's not always the case. Back in the 80s and 90s, sometimes yields would go up, but they were earning enough that that drop in prices didn't put the whole thing negative. It was just a smaller return. Because interest rates have been so low recently, that's where the red is coming from. Let's take a real short moment to talk about GDP.
Sure. So, Brian, late in the month of April, we saw the read for first quarter GDP, and it caught investors by surprise because it was a negative. So negative 1.4% annual growth. And if we dig into the components of GDP, it becomes a little bit clearer where that came from. So first of all, on the positive side, we see that personal consumption and business spending was very strong. In fact, both of those numbers, it was the strongest in many quarters. But where the negative came from was on the import side. and the minutia of how the calculation for GDP is done.
Yeah.
So basically, when a company imports a good that they want to put on their shelves, they're going to sell later. That actually counts as a negative when they buy that good, because it only counts as a positive towards GDP when they do the final sale of that good.
And that was the big surprise that came in compared to,
Yes.
again,
So that should reverse in future quarters as those goods come off the shelf and get sold to consumers. So not terribly concerned about the negative print here.
and just for the people that are paying close attention at home, the day that that GDP report came out, I would have thought that the markets would have reacted poorly. They were all green. Everything went up that day. So you could tell that the market itself wasn't concerned because of where within that GDP equation that the variances were coming from. Let's wrap it up with our forward outlook. Dan, what do we have to look forward to?
Yeah, so despite the volatility that investors have experienced year to date, we still count more positives than negatives. So just talking about the Fed for a second, yes, they're raising interest rates. We knew that. What we've learned in the past maybe 2 months is that they intend to do that faster than what we maybe originally thought at the beginning of the year. But end of the day, even if they raise interest rates 2 to 3% over the next year, they still started from zero. And we still expect to be in a good place with monetary policy when the Federal Reserve gets done here. First quarter earnings season, we're about halfway through, and very positive indications there. And just to think about volatility, I mean, volatility in the financial markets is normal. We generally experience a correction about, just over once a year. So hopefully this is our, one correction for the year that we're experiencing. But again, still count a lot more positives than negatives. So just, be patient with the volatility and do your best to ride it out.
Good. Well, to everybody at home, that's our summary for April. Thanks for watching, especially those of you that have watched all the way to the end. Don't forget to click down below, like and subscribe. And until next month, I'm Bryan Becker with Dan Brown from Richardson Financial. Thanks and have a good one.